So now the central banks are either going to have to let interest rates rise until they find a natural buyer.
Right.
But every 100 basis points for the United States borrowing is $300 billion. That's 9% of tax receipts. And we're already 100% of tax receipts if you look at Treasury spending plus entitlements. So now you're quickly, as rates rise due to all this, you're going to get into questions about sovereign debt sustainability of the European Union, of the United States of America. Now, are the central banks going to sit aside and just let the debt markets unwind? No, they're going to come in and they're going to print money into an inflation spike. So now oil's not 200, it's 250, 300. Now you've got an inflation spiral. What do you do? And I think this was part of Putin's calculus. I think it was absolutely part of his calculus is they can't take my oil out without destroying their own markets.
We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Luke Gromen, founder and president of FFTT. Thanks for joining me today, Luke.
Thanks for having me on, Tom. It's great to be here.
Great to have you back. And there's tons to talk about as always. So you've been tweeting lots recently about Russia. So I'd like to take some time to kind of try to understand the situation from your perspective, especially let's say the economic perspective. So what kind of other options does Russia's main currency, being oil and gas, give them? We know that the fiat currency obviously is the ruble, but how does the energy component of their economy, that they export, really give them a lot of other options?
Yeah, I think they're more drastic options, but I think they're options and they're just not being considered by a lot of people in the West at the moment. And what I said when I tweeted that was that nominally the ruble is Russia's currency, and it is collapsing against the dollar as a result of sanctions, and that's going to create problems. There's no question. With that said, I also noted that the functionally the currency, is oil. It's energy, and energy is rising as a currency is rising against everything. All currencies. And so it's not as black and white as pretty much every financial media we're seeing, in my view. In the short run, I think it is. It's pretty crystal clear, or pretty clear cut. But it's this more nuanced view where, and I think we saw a perfect example of it over the weekend, right? Which was we're going to kick Russia out of SWIFT. And then, we're going to kick Russia out of SWIFT except for their energy. Well, that whole except for the energy part is a very big message about relative power, right? We can't do it without collapsing our own system, is the quiet part that the Western leaders were not saying out loud. And that's just a function of Russia's output being so big as a percent of the global balance that energy prices would spike. If energy prices spiked with global debt where it is, particularly Western sovereign debt, you'd likely create a debt market crisis, a debt crash in Western debt, Western sovereign debt, that would look like global central banks, the Fed, the ECB in particular, capping interest rates, right? So the energy side, as we start from there, okay, there's something special about the energy. They are Xing out the energy. Then we can say, okay, we saw the story in Bloomberg on Friday where the Chinese said they are not providing, Chinese banks or offshore banks are not providing dollar financing for Russian commodities. And this kind of goes to show the whole narrative of this whole situation is very unbalanced in the West. And that's not saying I'm rooting for Russia or rooting against Ukraine, anything. I'm just factually, it's all one thing, basically. Or objectively, it's all one thing. And so this story came out. You saw a number of people rush to say, look, the Chinese are cutting off the Russians. Well, then you read in the story, it says the Chinese are actually still providing yuan-based financing, letters of credit, for Russian commodities. And you go, oh my gosh, that's huge. Because what that's telling you is that the Chinese are using this. Basically, the Americans have been fighting the transition away from the dollar for commodities forever. And here we actually have, by virtue of this crisis, the Americans are willingly pushing Russian commodity pricing to yuan. And the Chinese are saying, yeah, great, we'll take it. I checked in with a friend of mine who has decades of experience interacting with in energy markets, trading in energy markets around the world, very high level relationships around the world. And when I sent the article to him, he goes, I guarantee there are no limits on the amount of yuan deals that the Chinese banks will do. They are loving this. So when I say that this being their currency, this sort of indicates these indicate a type of leverage that is not being given any consideration in these Western media articles. This is, we can't sanction their energy because our own system will collapse. That's leverage. To the extent that there are willing or voluntary sanctions, that these banks won't put it on, the Chinese are going to step up and do it. Of course they will. Now, that then speaks to some other types of leverage Russia could use, right? So let's say, look, they're short energy. Without energy, they collapse. What happens if the Russians come out and say, listen, we only want rubles for our oil and gas, Europe? What are you going to do? What are they going to do? They're going to freeze in the dark? Or are they going to start selling euros to buy rubles to give them? It's possible, right? Mm-hmm. That's a step they could take. More extreme, Russia says, listen, we're only taking physical gold for our oil. That's it. And people say, well, great. I'm going to go buy physical gold. Well, everyone starts going to buy physical gold. You're promptly going to crash the paper market. Mm-hmm. And you're going to create some sort of force majeure situation. It's a highly levered market. You can't start pulling collateral out of a highly levered gold market. So there are some other things they can do. But I think at the first principles basis, their energy is leverage. When you talk about the petrodollar system, the fact that we could not sanction out the energy without collapsing the petrodollar system tells us the real leverage at the core is in the petro side of the petrodollar, not the dollar side of the petrodollar. So in the short run, yeah, sure. They're bombing the currency, and you've got guys on CNBC taking victory laps about how effective this was. But I just said to someone earlier today, like, I'm old enough to remember people taking victory laps on CNBC, in May of 2003 after we took Baghdad. 17 years later, it was 15 years of a shit show. So I think there are some other things here, and again, that leverage for that is, I think, quietly being demonstrated that energy has. Russia's not doing anything about it yet. To me, it strains credulity to think that Russia's going to sit here in silence and not do anything with that permanently. So let's see how that develops.
Right. So, Luke, there's a lot to get to there. Can this be considered basically an important signpost for the SWIFT system that, they're basically forcing the rest of the world to create solutions for Russia to get that energy out of there without using the dollar?
Yeah, I think this is Putin's gambit, and I think this is the West's gambit, and it's a huge gambit. It's everybody's putting all their chips in, and the question is, can we move this energy outside of the SWIFT system? Because if you can, the U.S. will have just encouraged the death of the post-$71 system. Full stop. Mm-hmm. They will have cut the throat themselves of the post-$71 system. If they can't, it will reinforce the power of that system. But again, I think it's going to be so disruptive that given the other leverage in the system, I think it's going to cause other problems. That the best case is that basically global central banks have to start printing money again because of disruption. So you're going to have this sort of stagflation continue. I think that's the sort of the good outcome. Mm-hmm. And I think the bad outcome is, China steps up and goes, yeah, we'll buy it all. We'll take, and there's some logistical issues that's an oversimplification. There's pipeline issues. That's not to minimize those, because some of those are serious in terms of how much China can buy right away. But to the extent that there is a workaround that is created, or to the extent that there is a trump card that Russia plays, where Russia says, look, we're not selling it for anything other than rubles. Mm-hmm. And now the Americans and the Europeans have to sell dollars and sell euros to buy rubles. their dependence on energy will force them to defend the ruble for Putin, and that's that's sort of the downside wild card. I think and these are things that there's just I'm not seeing a lot of consideration being given in sort of the soundbite media.
Mm-hmm. Yeah, and just thinking about that problem as is, that would basically freeze out most of Europe, correct? So, what do you think the likelihood of China saying, we'll buy it all? Do you think that that's a fairly distant possibility, considering the fact that they would just create a giant enemy of the rest of Europe?
And this is where it gets a little. This is why the China-Russia alliance / marriage of convenience, whatever you want to call it, it's really why the U.S. trying to take on both Russia and China is a bad idea, because you basically force them to need each other. Mm-hmm. If right now, last year the United States ran a record trade deficit against China. I forget the number off the top of my head. I want to say it's $350 billion, something like that. Those are dollars net that we sent to China. Mm-hmm. So we just saw today Shell pull away from a giant, I think, LNG terminal in Russia, in Sakhalin, Russia, way out on the far. I guess for them it's their eastern side, west of me. Mm-hmm. You saw BP pull out of a Rosneft JV yesterday, write down, I think maybe $25 billion or something. These are huge energy facilities, strategic assets. Mm-hmm. What's going to stop China from saying, hey, we're going to take some of the $350 billion the Americans just gave us last year alone for plastic trinkets and stuff, and we're going to buy these enormously strategic energy assets that we will be able to leverage and use for us forever. Nothing. There's nothing stopping that. And there is not a darn thing we can do. We can't sanction China. Everybody knows Sanction knows we can't sanction China. knows we can't sanction China. And Russia knows we can't sanction China. And we've managed to force the two of them together by attacking them both at the same time. So there's just this I think Europe is trying to sort of play both sides. I think, and you can see that if you look back historically, they've long been trying to buy energy in their own currency. Long time, 50 years they've been working on it. Mm-hmm. In 2018, Jean-Claude Juncker said, it's absurd that we're buying 97% of our energy in dollars. It costs us energy worth 300 billion euros a year. We should be buying it all in euros. We're buying it all in dollars. It's silly. Mm-hmm. So they've been repeatedly saying they want it. And so there's an element to this that I think the Europeans are happy with, right? If the dollar system, if the Americans accidentally kill the dollar system, the Europeans aren't exactly going to be unhappy as it relates to energy.
Right.
Now, where it gets weird is to the extent they may find themselves competing with the Chinese, to your point, and this too speaks to the challenge of really where, again, when you think about relative power, the common perception of relative power levels, to me, this whole situation where this is going to end is China's relative power is going to go way up, Russia's is going to go up, the US's is going to go down, and Europe's going to go down and maybe way down. But Europe might, depending how they play this, might end up going down less than the US. The big loser in this might, in the long run, be the US. And I think part of the reason that is ultimately if the Chinese can, if we're going to go after both Russia and China, the Chinese are going to get much cheaper energy assets because of the sanctions we're putting on Russia, while the Europeans are the Americans' best allies in Eurasia. So basically, we need Europe to thrive industrially to be able to compete with China in the long run. If the Europeans go down, we're in trouble. Mm-hmm. But what we're doing is actively hurting European energy independence in the short run, making China's much more energy independent, lower cost energy resources, raising Europe's cost of energy. So there's these dynamics, right? Because at the same time, so that looks like we are actively hurting Europe. helping China at the time where we're supposed to be trying to hurt Russia and China. At the same time, the Europeans, I think, realize that we have been trying to hurt their energy situation for a long time.
Mm-hmm.
And so that's why I say, well, they're kind of playing both sides, right? I think they understand that that's not a good situation for them. So they need to try to keep us happy and say, yes, we're going to sanction Russia. And then at the same time, take steps to try to improve their independence or improve their relationship over time with, if not Russia in the short run. They're certainly not cutting back any buying of energy from Russia, but the Chinese as well. So there's, it sounds sort of talking in a circle as I talk through it, but that's really what's happening here is this, it's a very incestuous set of interplaying dynamics on the trade side that if you boil it down to one thing, in a levered world, it's a very dangerous thing to be trying to sanction the world's biggest energy exporter. But here we are.
Mm-hmm. Yeah, it seems that there's always, a real trade-off here. And, I was going to bring up the example. I know there was a chart that I mentioned with Jeff Snyder last week that I know you retweeted as well. It's basically Russia's gold reserves going up and to the right, whereas their dollar holdings are going down to the right. And,
sure.
That just makes me wonder how, in this situation, that affects let's say the common Russian person, considering that we've seen such a very quick and sharp devaluation of the ruble, that how that's affecting, the people of Russia versus the government of Russia having, for all intents and purposes, their real currency, their energy become just that much more valuable, right?
Yeah, and I think it's, I think, I was just seeing an article the other day showing that, Russian citizens' holdings of gold at like an all-time high. They've been buying it hand over fist ever since 2014. Mm-hmm. Because I think there's this, I think it hurts the Russian citizens. There's no question. And I think it's going to continue to. I also know that this is not the average Russian citizen's first rodeo when it comes to currency debate, right? They went through two hyperinflations in the 90s, 08. They had the ruble got hit with the oil price crash, 2014. Ruble got hit with the oil price crash. So it's not like, if you're a Russian citizen sitting with all of your all of your savings sitting in a bank account in rubles, mm-hmm. you sort of haven't been paying attention. Mm-hmm. So that's, they're probably setting a lot of it in dollars. To the extent they can, gold to the extent they can. With that said, I think the fact that Putin did this, which surprised me, points to one of two things. Either he has lost his mind, or he's off, or he's irrational, or some of the things that we've seen out of like Senator Marco Rubio, sort of pseudo tweeting out intelligence, right? Basically, his, I can't say more than this, but the guy's losing his mind. Mm-hmm. Possible. I have no way of knowing that. The other option is one of two things, I guess. It's sort of A and B. A is Russia's situation is so perilous that they had to act now as it relates. And some of that might be a forcing function with, Zelensky having talked about getting nukes and the NATO thing. It just felt like they had to do it now. Mm-hmm. The other option is that they saw their window of opportunity, which is in a peak cheap oil world, in a peak cheap energy world, which we are clearly in, with U.S. shale clearly unable to grow production without a significant increase in oil prices, and with Saudi Arabia possibly peaking in terms of their oil production and others in OPEC. That plus the debt side for Western sovereigns, our fiscal situation is so fragile that they just figured, hey, let's just go cause chaos, right? So there's this balance of trying to figure out, did he miscalculate? Is he crazy? Possible. Is he crazy? Possible. Did he miscalculate? Possible. Mm-hmm. Is it possible that he's saying, listen, I know this is going to hurt, but we got to do this now, because the alternative is we're going to keep using the dollar to squeeze them. We're going to keep using the dollar to squeeze China. And that's sort of the unpleasantries of statecraft, I guess, if you will, and that's what they want to have happen. And so it's hard to argue sort of counterfactuals, right, of what would have happened. But I think in my opinion, why surprise everyone to go now is that he felt like he had a window, and the window of doing this will improve the Russian state's relative power position and his flexibility to improve living standards going forward more than the cost in the short run. But that's highly speculative.
Mm-hmm. Luke, I'd like to go back to something that you had kind of mentioned before about if they were actually, sanctioning or blocking the ability for Russia to transact on the SWIFT system with their energy, how would that basically crash the debt markets or the bond markets? I think that's worth going through a little bit more.
Sure. So, like if Russia exports, I don't know, 4.8 million barrels a day of oil, and then I don't even know what it is on gas, but it's significant, particularly to Europe. And if you look at, so globally, I think the world produces 96, 98 million barrels a day, 100 million barrels a day, whatever. However, I think you have to look at it on a net exports basis, right? So on a net export basis, you're probably talking about 40, 45 million barrels of net exports out there, maybe 50, maybe less, maybe 35, right? So you're talking, let's just say for round math, 10% of the market. Mm-hmm. So if you sanction Russia out of it, you're going to assume some leakage, right, with Iran and whatever, but you can sort of track those oil tankers. But the point is that you're going to take 10% of the oil market out. Take 10% of the oil market out. What's the new clearing price? 200, 250, maybe. Let's say 200 for round math. Mm-hmm. $200 a barrel. Natural gas, let's say same thing. I don't, it's a local market, right? We're paying a lot less than the Europeans are here, or Japanese are, whatever. Let's say natural gas goes up 100% globally as well.
Right.
Europe's in a recession. Europe's debt to GDP is whatever it is. That you're going to start having debt default. You're going to start, rates are going to rise because look, who's the idiot? One of two things: either debt's going to default because you're going into recession. At the same time, inflation's rising, and so you're going to have bonds selling off because of that too. Right? I mean, you saw it even last week. German PPI is 25%. The Bund's yielding like zero. Like mm-hmm. the whole reason that some people are still holding debt, the people that have a choice, right? There's regulatory and there's duration match. There's a whole bunch of reasons of just sort of mindless bond buying. But to the portion of the market that's not mindless bond buying is buying because they are convinced that inflation is going to roll over, the economy is going to slow, and they're actually going to end up with something close to a real yield. Mm-hmm. You take Russian oil out of it, you're not going to have anything resembling a positive real yield for years. And now they're going to go, forget it, I'm out. Mm-hmm. Who's the buyer? There is no buyer. The buyers are the central banks. So now the central banks are either going to have to let interest rates rise until they find a natural buyer.
Right.
But because I'll use the United States because I'm most familiar with it. It's the central, it's the reserve currency. Every 100 basis points for the United States borrowing is $300 billion. That's 9% of tax receipts. And we're already 100% of tax receipts if you look at Treasury spending plus entitlements. Mm-hmm. So now you're quickly, as rates rise due to all this, you're going to get into questions about the sovereign debt sustainability of the European Union, of the United States of America. Now, are the central banks going to sit aside and just let the debt markets unwind? No, they're going to come in and they're going to print money into an inflation spike. So now oil's not 200, it's 250, 300. Now you've got an inflation spiral. What do you do? And I think this was part of Putin's calculus. I think it was absolutely part of his calculus is they can't take my oil out without destroying their own markets. And so that's if that was the calculus, you would have expected to see the West say, no, we're not going to do sanctions on energy. So far, that's looking like a pretty good assertion. So we'll see. Now, the fact that they can't take out the energy, that then filters back into some of these other options that Russia may have.
I really appreciate, trying to talk through this very, very complicated picture with you, Luke. And, there was another piece that you mentioned earlier as well that I'd like to dig into a bit more. We think about the role of gold and the currency wars that we're seeing here, but you pointed out that the LBMA and the Comex could be the Achilles heel of the US dollar system. So can you explain your thinking a little bit more on that topic, please?
Yeah, and this ties into sort of unappreciated weapons, currency war weapons the Russians can use. And Jim Rickards wrote about this 10 years ago. FOFOA wrote about this. A friend of mine, Pete Traska, wrote about this. The point is that the unallocated London gold market, it's not appreciated that much. That basically gold, Paul Volcker in the 70s said gold is my enemy, right? Gold is the enemy. Gold, it's not the enemy. It's like saying a thermometer in Arizona in June is the enemy. It's not the enemy. It's just you're in Arizona in June. It's friggin' hot. And so in the same way, the way central bankers have managed, it was their enemy because they would have to tighten rates when they didn't want to tighten rates, right? It was forcing them to actually exercise discipline. So what they have done to control these markets has been to allow the robust expansion of paper gold, unallocated gold in London in particular, where there are unallocated over-the-counter claims. Who knows? It's been estimated anywhere 20x, 50x, 100x, 1000x. Nobody knows. Mm-hmm. You have some guesses. They're all guesses. Comex also, it has gotten more paper-driven. I mean, I had one of the biggest physical gold traders in the world tell me, I think 4 years ago, that when he started in the business 20 years prior to that, probably 20% of the volume on Comex in the gold markets was at least related to a physical ounce. He's like, that's now probably 2%, and the volume's probably risen 3, 4, 5x. So they've basically, it's not the same thing in Comex as isn't unallocated. But the bottom line is if you have inflation, and that inflation drives and monetary inflation, you expand the monetary base, you run big deficits. If that drives gold demand, there's two ways to deal with that gold demand. You can let the price of gold rise, more dollars chasing the same gold price up, or you can let the number of paper claims on gold ounces rise. And that way, with that, you can manage the pace of gold's rise. Mm-hmm. That's what they have chosen to do. That, though, is the weak link, because if you look at Comex inventories, a small hedge fund could go to Comex and say, I want to take all of it and break the market. Mm-hmm. The fact that they don't, there's an extraordinary informational value that most people just ignore. The fact that some small hedge fund hasn't gone and created a short squeeze like they did in AMC or like GameStop last year, right? Mm-hmm. Why not? Why not is because you get talked to by someone who has haircuts like ours. And they're like, you don't understand. That's not going to happen. We're going to cash settle you and you will be persona non grata, best case. Mm-hmm. And that's just, again, this is statecraft. Gold is not just some free market. It is a political metal. Mm-hmm. And so now, if you're going to do that, if you're going to do the Hunt Brothers short squeeze, right? I'm not speculating. The Hunt Brothers tried this in mm-hmm. silver in 1980. The system has to protect itself. The Hunt Brothers were not a sovereign. The Hunt Brothers were not the biggest oil exporter in the world, like Russia is. The Hunt Brothers did not have nuclear weapons. The Hunt Brothers did not have an army. The Hunt Brothers were not closely allied with China, who's the world, so on and so forth, right? It's a very different game at that level. And that's why I say people underappreciate the leverage that the energy that Russia has as their real currency could be. What if Russia comes out and just says, listen, we and China have agreed that to get around sanctions, we are going to transact in, we're going to settle gold or oil, in physical gold at a new ratio of 1,000 barrels per ounce of gold. And everyone is going to go, oh my God, this is a great arbitrage, right? I'm going to go buy 1,000 ounces of Comex gold or GLD, and then I'm going to convert it to physical, mm-hmm. and then I'm going to take the physical over to Russia, and I'm going to get 1,000 barrels of oil, and then I'm going to sell the oil, and I'm going to get rich. And the market properly is going to shut down. It's going to crash mm-hmm. instantly. The paper gold markets will just go, boop, cash settle everybody, game over.
Right.
And then you're going to, the oil, the real value is going to reprice gold. Mm-hmm. Again, I'm not saying that will happen. I think that's a long shot. If I was Putin and if I was pushed that far, that's what I would do. Mm-hmm. Because again, he already has the gold. Great. He's going to write up the value. People keep saying he's going to sell his gold. He might sell some gold. I don't know. But I don't think he will. Mm-hmm. Why sell your gold when you have the oil? You can use the oil to revalue the gold to give you all the dollars you need. Right. So, maybe they end up sanctioning gold. That's very possible. He does this and they say, OK, gold, you're a terrorist if you own gold. Right. Justin Trudeau, cancel everybody's gold. Right. Mm-hmm. If you're a gold in Canada, you've got to give it up immediately. It's possible. Like that's suddenly on the table after the last 2 weeks. Right. Not just what we've seen Russian sanctions, but we've seen, in Canada. Mm-hmm. But that's why I say it's the weak link is it's so levered and there's so little physical gold there. It would take so little money. It's just nobody can do it unless, it's an act of warfare. It's an act of political warfare. Now, Putin invaded, act of warfare. The West just shut down his FX reserves, act of warfare. Mm-hmm. What's the escalation? Could that be it? Yeah, that could be it.
Seems like the almost like the grenade pin for the world economy in a way, right?
Yes and no. I mean, it would be the grenade.
Or one of them, yeah.
Yeah, one of them for sure. For the dollar system, yeah, it would be. You would basically be launching a new system at that point, right? It would be, gold priced at whatever, because really at that point, you think about it, if Russia and China, and I would suspect the Saudis would probably go along with it. Certainly the Iranians, the Venezuelans would, which is a decent chunk of the oil market. Now the U.S. will be faced with a choice, right? If they say, hey, it's 1,000 barrels an ounce transacting between these parties, the U.S. can say, gold is still 2,000 an ounce. Well, that means that oil's $2. The United States oil business is dead, right? Oil in the U.S. is too. Shale's gone. U.S. is now importing a bunch of oil, by the way, from Russia, who wants
Hopefully.
gold. Right. Exactly. Or our economy is dead, collapse, gas lines, riots, etc. Mm-hmm. Or the United States says, okay, oil's 100, gold's 100,000 an ounce. Mm-hmm. And now gold is the de facto primary reserve asset of the world. And by virtue of weaponizing FX reserves, the United States has unwittingly basically just sort of applied the coup de grace to the post-$71 system. And that would be the choice they'd face. No, you could also say, listen, we're going to put up a new Cold Wall, there's a new Iron Curtain, right? The Chinese and the Russians are going to do deals over here at that rate, and we're going to do our deals here. And this is, you can't send gold overseas, and this is, you can't own gold and all these. And there's ways you could do that. But again, the problem is where the United States interacts with Russia in the oil markets and with China in the everything else markets, right? We go to buy one of these bad boys, right? Oh, made in China. Until you get rid of that, you're going to have this leakage between that system and this system, and that's going to put upward pressure on gold or downward pressure on oil. So it's very much in a state of flux, but it all ties back to this point where this gold system is the Achilles heel, because it has been basically, it's this tiny little sliver of physical gold holding up this giant sort of inverted pyramid of paper claims on gold of unknown size. And, the Jenga block at the bottom, if you will, is the little sliver of physical. Mm-hmm. And that little sliver of physical is nowhere near valued appropriately relative to the value of gold, of oil out there that Russia could deploy to just say, you know what, we're gonna pull the Jenga block out and let the whole paper facade come down, and then it's up to you, USA. What do you want to do? Do you want to be short oil? Or do you want to have gold be devaluing the dollar?
Mm-hmm. So, Luke, we've talked about a couple different scenarios here. Are there any ways that this plays out that are good for the U.S. dollar? It seems like many of them are just negative, where you're creating incentives for everyone to be moving away from using the U.S. dollar.
No, yeah, there's ways you can get that to be good for the dollar, but it's not really good for humanity. Look, we could cut off Russian energy. We could sanction Russian energy. We can sanction China in its entirety. And the dollar is going to go to the friggin' moon, right? Like there's going to be shortages at the store and oil lines and all this, but the Dixie will be 150, 200, 250. It won't buy us anything, but it'll be really high against other fiat, right? It'll be one of these things like, hey, great, the DXY is at 200. Our dollar's so strong. You'll go to the grocery store or you'll go to the gas station and you'll wait, 3 hours to get 3 gallons of gas. And you're like, why, if my dollar's so strong, why is it not buying me anything? So there are ways mechanically, again, if you implement draconian enough, but again, it's this fine line of you go too far and people just go around you, right? That's silly. And that's part of the problem of this whole thing is it becomes a Pyrrhic victory, right? Hey, the dollars, DXY is 200, except I can't get any gas.
Right.
So.
And again, that comes back to what we were talking about earlier about those economic trade-offs either way. So how could the US somehow, let's say, weaponize Bitcoin in that same kind of regard?
Yeah, I mean, if Russia did that with gold, then the U.S. could say, "Listen, we're going to settle in Bitcoin, right? The American, that's going to be our thing." And China gave away a huge weakness, I think, in kicking out Bitcoin miners. I hear it wasn't because they were afraid of the competition. I hear it's because they have energy issues, and the energy issues are water issues. Mm-hmm. And so, basically, if the United States adopts Bitcoin as a reserve asset, I think number one, you've seen the pattern that empirically Bitcoin has risen against gold over the life of the existence of Bitcoin. And when you look at the number go up algorithm, right? The sort of just the how that works, the relative scarcity, it would stand to reason that it would continue to go up. Bitcoin to me is just an energy derivative, if you will, currency. Mm-hmm. Or reserve asset, excuse me, not currency. Furthermore, if China can't do it because they have power constraints, because they have water constraints, it changes the terms of the game from, whatever we describe them today to who's got more water. Right? You're short water, we're not. We're going to produce more. It's who's short power. Who's short, and right now we're in a better position. And endemically, we'll probably continue to be in a position because even setting aside, say China gets, they have less, or they fix, or they put in new plants to overcome the hydro base load. Nuke still takes a ton of water. Coal still takes a ton of water. These plants take tons of water to run, and they don't have tons of water. And so they're running into power constraints, and that, a currency that forces you to burn a lot of power for its proof of work actually tilts in our favor, right? It shifts the board in our favor. So do I think we're going to do that? No, because, there's too many dogmatic people in Washington. I think they unfortunately need this to go badly for a while, worse than I think it's going to go for another 5 to 10 years. But before they were to think of something like that. But there are a small number of people in Washington that do understand that, some very smart people. Jason Lowery's been talking about that publicly quite a bit, and I would put him right up there with anybody in terms of mental horsepower. And I think he's exactly right. Let's hope his message is heard. But that's how you could do that.
So, Luke, after speaking to Jeff Snyder the other day, I got a couple of questions from listeners asking if the Fed is less effective in some ways than many people think because of the EuroDollar system. Does that seem right to you?
I think it has the Fed trapped effectively, is another way of saying that. And so, yes and no. Like, to me, it's a moving bogey where the EuroDollar system means the Fed is going to have to keep doing more and more in terms of stimulus. Anytime they're not doing enough, you're going to see the dollar rise. You're going to see deflation. You're going to see, but ultimately, that's one side of the equation. The other side is the U.S. fiscal side, which is the again, we're talking about before, U.S. Treasury spending plus entitlement pay-goes are over 100% of tax receipts. Mm-hmm. And this is, I think, the dynamic that is underappreciated by sort of that crowd of like, well, it's just EuroDollar system is so big, Fed can't control it. And so it's going to be deflation forever, with spots of inflation. Up to a point. Once you get to a certain point, that deflation means that tax receipts aren't covering treasury spending and entitlements.
Right.
At that point, which we have been at since last March, the question then is the EuroDollar, is the Fed going to allow the EuroDollar system to create additional deflation and deflation of tax receipts, which means the United States will default on treasuries, treasury spending, treasuries, or entitlements. Mm-hmm. They don't, or defense, or everything else. They're going to have to start slashing spending, or will the Fed cover the difference?
Right.
And I think that view of the sort of the EuroDollar system is right to that point. And I think with a lot of the sort of deflation forever people with a point on the EuroDollar is they're missing the political reality of there is, in my opinion, zero chance that the Fed is going to allow that to happen. They're going to print the difference. Mm-hmm. And that difference gets bigger every year, right? I mean, we have tax receipts of, call it $4 trillion last year. It's an all-time record. Entitlement pay-goes are $2.7 trillion just alone, right? 65% right there. That's before we talk about treasuries, treasury spending, stimulus, defense is another 20%, right? So, you're talking about defense, treasury spending, and entitlements at 125% of tax receipts. So is the Fed really going to allow or force the EuroDollar market to defund the Defense Department as we're getting into this with Russia? There's no chance. Are they going to defund entitlements in an election year? No chance. Mm-hmm. They're going to default on treasuries? No chance. Okay, then the only other option is money print or go burr, right? And that's what I think they're missing is the real politic of they can't do enough. Oh, I assure you they can. They can buy every drop of dollar debt and put on their balance sheet. And I think that's where this is ultimately going is mm-hmm. the EuroDollar system will largely end up on the Fed's balance sheet. People say all the time, it's like the US is going to be Japan. Great. Okay, let's talk through that. Japan has, I think, 104, 120% of GDP on the BOJ's balance sheet. Mm-hmm. US is at 40. Except there's no big euro yen system. So we're going to put all our debt on, it's going to be 100% of GDP. It's going to be, the Fed's balance sheet. That's the Japan. If we're going to be Japan, that's our price target. That's a Fed's balance sheet price target, right? It's going to 120%. Mm-hmm. And you can get there by, doing EuroDollar market stuff. You can get there by doing, domestic treasuries, mortgage backs, et cetera. You can do it, right? And people say, well, Japan was deflationary. It's like, well, let's look at last year. We ran a big deficit and the Fed monetized it. Was it deflationary for us? No. When you're a twin deficit nation and you run the Japan playbook, you don't become Japan, you become Argentina. And I think it's the U.S. is heading toward being Argentina with U.S. characteristics where, we have this high CPI and we have, the Fed buys what they have to do unless they can, either come up with some economic productivity miracles or they can restructure entitlements or they can slash defense. They really can't cut rates anymore. So that's where I think, my argument with Jeff is of sort of, I agree that the EuroDollar is enforcing its will mm-hmm. On the system. And that all else equal, that will is absolutely deflationary and dollar positive. Where that runs into, an immovable object running into an unstoppable force is the U.S. government is not going to let the EuroDollar system defund its Defense Department, cut its entitlement spending, or cut or default on its treasuries. It's just not.
Mm-hmm. That was a great explanation, Luke. Thank you. So, as we're on the topic of the Fed, do you think that this latest turn of events, from your perspective, changes the Fed's hawkish stance? And for example, delay rate hikes or stop tightening?
I do. Maybe they still do a token one, especially since, if they can get the dollar up, it puts some more pressure on the ruble, mm-hmm. And sort of, further weaponizes the dollar system. But again, they're only going to do that to the point where it starts to hurt ourselves. And once that goes too far, that'll be it. And so it'll be interesting to see the economic measures. But I think beyond a token hike, I think they're going to have to basically, about face and go into, incremental liquidity as needed. I don't think we're at the spot yet where they're going to sort of re-up QE, but I think that's where this, I think that was always going to be the end game. I think that spot where that happened has probably been brought forward by a couple of quarters.
Mm-hmm. So when we consider all the, let's say the reasons that the Fed wanted to start raising interest rates to combat inflation, do you think it's possible that inflation starts to basically ease this year anyway as supply chains catch up?
Prior to last week, it probably would have eased.
Yeah.
Supply chains, I think a lot of it depends on what China does and what we do versus China, and what the U.S. State Department does with China. The Chinese government came out with a white paper called was it weaponizing supply chains or export controls, right? Export controls and supply chains or something, right? So it was sort of a thinly veiled threat to the U.S. Like, listen, like stop with the stop with the Xinjiang, stop with the Taiwan, stop with all this stuff that where we disagree, or you're going to continue to have supply chain problems. And it's very easy for them to do that. Oops, we found two COVID cases in, here, or, we need an inspection for this or this. That's sort of how, they do things. I remember them doing it. I used to work for the firm where we had this excellent ag analyst, and, she would tell us like, yeah, they're over inventoried on soybeans. And so they're saying this next shipment's got a bunch of GMO stuff on it. And they said they didn't want GMO, and none of it's GMO, but it's just how they deal with how they deal with the flow. So, all else equal in a vacuum, I would expect that supply chain should normalize to some degree. Now, though,
there's just too many cards on the table, it seems, to be able to really point to a concrete answer for that, right?
Yeah, I mean, look, when Russia was in trouble in the late 90s, like, we were as solid financially as we ever were. We're solid fiscally. We had much better demographics. The world had better demographics. And it was still nearly enough to blow up the whole world, right? The Fed had to bail out long-term capital. So, like, to me, the view that this won't be highly disruptive, what we just lived through in the last 3-4 days, it's so early, but I unfortunately think it's likely to be very disruptive. Now, if the economy collapses and we go into a severe depression, supply chains should normalize, right? But that's going to bring up a whole other host of problems, because that recession isn't a policy option anymore with the U.S.'s sovereign debt where it is and with the ECB's, with the EU's sovereign debt where it is. They'll default, right? So they can't, it gets back to the whole point with the EuroDollar system that Jeff makes. Like, that's the political no-go. The recession it's not an option.
So, Luke, you recently pointed out that gold rose sharply as the Fed bailed out the repo market in 2019. So do you see gold as pricing in that risk or responding to it for some reason? Was that one of the main drivers for that price appreciation in gold?
Over the last several weeks, you mean?
In 2019, when we saw the price rise, you kind of made the parallel that gold was in some ways responding to the Fed bailing out the repo market. So is that kind of a fair statement? Was that you considered that one of the drivers for that rise in the price of gold?
Yeah, if you go back to 2019, I want to say June, July of 2019, the gold market all of a sudden started acting very, very strong. It had been trading for 2019 to 2030 for almost 6 years. It had been in like a 1,000 to 1050 to 1350 range. And then summer of 2019, it took off and never came back. I don't think it got that low in March of 20, but I could be wrong. Anyway, I think what was starting to happen in summer of 19 was that the gold market was sniffing out that the Fed was going to have to not just cut rates, but start growing their balance sheet again. If you look back, they had the Fed had to back off in 4Q19. All right, they were tightening, and then Powell had to back off. And then in the first half of 2019, you started seeing some things, domestic funding markets suggesting that there was a dollar shortage in domestic funding markets. The Fed cut rates, I want to say July of that year, when just 6 months before they were supposed to be tightening a lot more, 7 months before. And to me, by July of that year, it was very obvious the Fed was going to have to significantly increase their balance sheet, as opposed to continue to shrink it, which they were still doing at that time. So I think gold was starting to sniff that out. And so if you look at gold, May, June of 19 through, I don't know, early 20, I want to say it's probably 1,300 to 1,700, 1,800, something like that. It's a big move. So yeah, I would attribute that to not just discounting the repo rate crisis, but I would say expecting, basically discounting expectations of more Fed liquidity in response to the forces that ultimately manifested as the repo rate spike.
Excellent. So, Luke, has your attitude and really your considerations towards investing in gold miners changed recently as we saw Trudeau's actions in Canada in the last 3 weeks here?
That's a good question. I've always advocated most exposure, physical gold held out of the system, and that hasn't changed. And I don't think that changes with what Trudeau did. I do think if you're objective, and I own a lot of gold miners. I like gold miners. I have some good friends in gold miners, some of which in Canada. So I want to be fully disclosing of my relationships. With that said, we're now in a new world. We're in a new world, right? We just saw up until this weekend, it was considered. The FX reserves had always had sovereign immunity, right? There was no sovereign that was going to take some other sovereign's FX reserves. Mm-hmm. In Canada, as an American, looking at Canada, what happened over the last 3 weeks, stunned. I was blown away. Never would have guessed it. In terms of in particular, the banking angle, which my understanding is Trudeau reversed it pretty quickly. My guess is there were some very brief, loud, and one-sided conversations with him about what he just introduced. And so hopefully that was enough to sort of say, like, hey, here's what you're going to do, right? You're going to trigger a bank run. Mm-hmm. Is that what you want? In the context of the global Russia sovereign thing that we're living through, if gold is repriced, if all of a sudden gold is de facto a reserve asset at a much higher price, mm-hmm. you then go to the next line of thinking, which is the gold miners are now the reserve asset creators. Okay. If the gold miners are the gold or the sovereign reserve asset creators, in my view, they will not be allowed to remain as private entities. You're not going to have a sovereign having a private gold miner creating the sovereign reserve asset. I think what you will have is some version of, hey, gold miners, you're going to keep the first $5,000 an ounce for your profits. And then everything above that goes to us, the sovereign. Mm-hmm. In that extreme scenario. Again, this is not my base case. This is a tail risk, but we have to start thinking of these things given what we've seen with it. So what does that look like for gold miners? Do I sell my gold miners? No, I don't sell my gold miners because at $5,000 an ounce, these guys their dividends are probably the side bigger than their current share price. Mm-hmm. But what I do think it says is that we must consider the possibility, at least, given what we've seen in the last 3 weeks in Canada this weekend, that that if we get a gold bull market in the way that I'm describing, that the physical will outperform the miners, unlike the 70s where the miners outperform the physical, because the wild upside leverage will be taken by the sovereign in which the gold is domiciled, even in places like Canada and the US, because gold will be moving back into the system as a reserve asset, if that makes sense.
So do you think that this has really set a dangerous precedent for the rest of the world to follow Trudeau's actions?
Yes. Yeah. And I think that's exactly what he was told. I mean, I have no inside knowledge of that, but mm-hmm. I can only imagine what the bankers were saying to him. Mm-hmm. Wow. I mean, it's very dangerous. It's very dangerous because you're just going to get, especially now that there is such an easy capital flight mechanism, right? It's not the easiest thing to buy gold, right? It's kind of a pain in the ass, quite frankly. It's really easy to buy Bitcoin. Super easy. You take your money out of the bank, just boom, every day, just drain your bank account, stick in Bitcoin, cold storage. And so, yeah, I do think it was a dangerous precedent. So hopefully that'll be the last we see of it. But we just saw another example of it this weekend at the international level. So who knows?
But when we think about the way that you could control, let's say, exactly what you said of draining your bank account and putting it straight into Bitcoin, if they really wanted to, it doesn't seem like a huge step to really control the on ramps and off ramps to getting your fiat currency into crypto, right?
100%. And I think that's something anyone that owns crypto, it's something myself that Bitcoin specifically, because that's really the one that I own. That's the one I focus on. But yeah, I think if you own Bitcoin, I think in, again, the same 3-week span that we've seen in Canada and what we've seen in, with Russia, et cetera, I think you need to own Bitcoin with the understanding that there is a non-zero risk that you may be able to be allowed to own that Bitcoin, but you will not be able to access it for years at a time and to allocate your position in that way. So, for example, U.S. made gold illegal in 1933. It was not legal for an American private citizen to own gold again until 1974. So they didn't go around and check under your couch cushions or, if you had a safe, but you couldn't take it to a bank and sell it. Right. I'm sure there were black markets for it. I'm sure that would be the case, but that's black market in physical gold is with cash is very different than a black market in Bitcoin where you're on, you're coming in and out of an exchange, right? Or, there's probably not a lot of, I know I'm not technically savvy enough to get it off from cold storage here to cold storage there. And I probably could learn it. There's probably ways around it. I'm not the right guy to talk to about that. But I think your point's a very valid one, which is for 90% or more of the Bitcoin people, controlling the on and off ramps would be enough. And I think understanding that in the context of what has happened in the last 3 weeks, I think we have to. I think it should affect position sizing, right? I know it has. I know I've thought about it. It's like, okay, here's what I have in Bitcoin, and if I can't get it out for 10 years, am I okay? Yeah, I don't want that locked. Do I want that amount of money locked up for 10 years? If the answer is no, that's something I think as a Bitcoin holder you have to think about, unless you're prepared to, cold storage, all this sort of, go to find a locale where you can get it out, whatever. It's so anyway. That's I think it's a very good question.
Yeah, those are some great considerations, and it just kind of makes me think about the fact that at times like this, it makes me want to think that I did what I could when it was easy to be able to make those transactions and, let's say, put some Bitcoin or some gold away before, like you say, it becomes a pain in the ass to trade your money or your fiat currency into either of those asset classes. So, Luke, I'd like to kind of wrap up by just asking you, what are the asset classes that you think are going to preserve wealth, or if not grow your wealth in this current negative real interest rate environment?
So I think the best way to do it is to break it down into two baskets. I think there are politically acceptable inflation hedges. Three baskets: politically acceptable inflation hedges, politically unacceptable inflation hedges, and then cash, which I like holding just to hedge volatility and give myself some optionality. And so in the politically acceptable, I like commodity equities, industrial equities, in particular, and then energy, agricultural commodities, electric vehicle related commodities, those types of things, and then certain types of niche real estate. Real estate I think is a category very much in flux. So it's residential real estate is insane, for lack of a better word. It seems like everywhere. So I don't know that I want to go chasing, but if you can find a reasonably priced lake house, things that have some sort of finiteness to them that you can generate some cash flow, beach house, these types of things where you can at least have some sort of positive carry relative to the note interest rate. that type of thing. Farmland, I think, is interesting. Certain niche types of ag land. Now, again, ag land is interesting only to the extent that you can, buy it and hold it as the inflation hedge. The prices there have gone insane too. So it's all relative. So those are those are the politically acceptable inflation hedges that I mentioned. The politically unacceptable, Bitcoin, gold. I like both of those. Gold miners, I would put almost in between the two. I think it's sort of a hybrid between unacceptable and acceptable. When you look at them, they're one of the few cheap asset classes left anywhere in the earth, which is really, so it's fascinating, right? Because even if you say, well, I just want to buy things for I'm a strict value investor, like gold miners. Like after the gold miners and energy, the list gets pretty short. And you can make a case, some would say, well, the gold, the energy guys are over earning, because, oil's 100 and it's going to go cheaper. Maybe, I don't know. But gold is it's not even back to all-time highs. And, nice coupons, low debt, discipline, peak cheap gold, all this stuff. There's a whole lot of catalysts, right? So basically the only reason not to is gold is stupid and gold's never going to be used again. And, okay, great. Like you, Charlie Munger, it's fine. But objectively, gold miners are one of the few really attractive value segments of the market out there. So I would almost put them as a hybrid. And then, like I said, the pile of cash is just about optionality. So that's how I'm thinking about my investments. It's just sort of those three things. I don't try to trade. I am positioned for what I think is just big secular cycle. I think a 40-year period of disinflation has ended. I think last week was the exclamation point on that, to be honest. And so I'm not worried about sort of disinflation or whatever. I would prefer to have my assets in a place where, listen, maybe we go through some disinflation, maybe they underperform for a bit, but again, that realpolitik point of the sovereign debt positions are so bad, they're going to have to print the money. And I just want to be there for that. I want to try to trade around that because it's big, it's volatile, it's complex, it's political, it's difficult to get the timing right. Just be there.
Yeah, that's an excellent point, Luke. I want to thank you for a really interesting, excellent conversation. Of course, you're available at fftt-llc.com, and you put out a lot of great information and great insights at Luke Gromen on Twitter as well. Anywhere else you'd like to add, Luke?
No, that's it. Check us out either place, and thank you very much for listening.
Thank you, Luke. Really appreciate your perspective today.
Absolutely. Thanks for having me on again, Tom. It was great talking.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.